So in this video, I will do a candle by candle analysis of the weekly chart of SCI. This is Shipping Corporation of India. In this video, I would like to illustrate to you how a professional positional stock trader should study the price movement on the weekly time frame chart. I will not discuss the daily. I will stick to the weekly in this video. So let's do a quick analysis of this weekly time frame chart. As you can see here, this is an old chart. This is 2020. So as per the SEBI regulations, we are allowed to discuss this chart. As you notice here, the stock has already broken out of base 1. So this is December 2020. If you go back to December 19, somewhere here. So if you notice from here till here, that's the high, that's the 52-week high. So the high of this bar is the breakout point. Okay. So let's draw that. So this is 51.82. Just a second. So I will draw a line there, 51.82. And let me give it yellow color. And let us give it some thickness. Okay. So the stock broke out of that base. This is base number 1. And at the time when the stock broke out, the relative strength of the stock was 37. So this was not meeting our criteria. However, if you look at the breakout was very powerful on high volume. So obviously that is going to increase the relative strength of the stock. So even though base 1 is not a trade which is eligible for us, base 2 could possibly a base where it could come within our filtering criteria. Now I am assuming that before you take the trade, you have done all the liquidity, comparative, technical, fundamental, and market analysis. So let's assume that on this stock, we do all of that, and the stock, when it reaches base 2, it qualifies or it meets our criteria. So now that the stock has broken out of base 1, what are we looking for? We are looking for base 2. But at what point in time are we looking for base 2? Well, we want the stock to go up 20 to 25% from this yellow line and then start forming a base. If it goes up more than 25%, like 40%, 50%, that is extended price movement. That makes base number 2 very risky. Okay. So let's see what is the price movement. Let's see where the base begins to form. How do you know that the base has started to form? Well, you need 3 weeks of consolidation, which means you need 3 weekly bars. All the 3 bars, their high should be below the high of the previous bar. Okay, so let me illustrate that. Let us move the price forward. So if you notice, this bar, the high of this bar is below the high of this bar, which means probably the base formation has begun. We don't have confirmation yet, but probably the base formation has begun. If we get 2 more bars, the high of those 2 bars are below the high of this candle, this bar, then we have the confirmation of a base. Remember, we need 3 weeks of consolidation on the weekly time frame chart. But look what happens next week. The high of this bar is taken out. So now the base confirmation, we did not get the base confirmation. Now we have to wait for the next bar. Okay. So let's see what happens. Again, notice here, after this bar, you have an entire weekly bar and the high of the bar is below the high of this bar. So here you might think that a base formation has begun if we get 2 more weeks of lower high compared to the high of this bar. That's a confirmation of a base. But again, that does not happen. See, this bar takes out the high of this bar, correct? So again, we still don't have base confirmation. But now let's see what happens. See, now you have the confirmation. If you look at the high of this bar, that is 72.69, you have 3 consecutive weeks where the high of all the 3 bars are below the high of this bar, which means the base is now confirmed. It's confirmed that base 2 has started. How do you know base 2 has started? Because the price from the pivot point has moved up more than 25%. So if you measure the distance from the yellow line here till the high of this bar, exactly the high of this bar, it's 40%. So it's gone beyond 25%, which means the stock should start forming a base after 25%, correct? But it has gone way beyond 25%, which is 40%, which means the extended price action after a breakout from base 1 increases the risk in the stock. Notice that this 40% move came very fast in just 1.5 months. Why? Because the stock previously took a lot of time to consolidate. We are talking from November 9, 2019 to December 2020. For an entire year, the stock was consolidating. So the longer a stock takes to consolidate, the faster it goes up when it actually breaks out. Okay, let me repeat that. The longer a stock takes to consolidate, the faster it breaks out. Another point is the faster it breaks out, the longer the base it will form after that breakout. So if the price movement gets extended, the length of the next base is likely to be longer because it will take a lot of time to rest because it has moved up very fast in a very short period of time. Okay, this is a logical, it's a very logical discussion. But now you have a flat base formation. Okay, you look at the high of this bar, which is 72.69. Okay, let's see when it breaks out of that base 2. See, it breaks out here. So let me remove this breakout candle. Have a look at this. This is base number 2, flat base. Let's draw the pivot range so this is 72.69. Let's draw the pivot range. I'll give it blue color. This is 72.69. I will take out my calculator. So 72.69 multiplied by 1.05, 76.32. This is 76.32. Let's draw the green selling zone. Okay. This is 72.69 multiplied by 1.20, 87.22, 87.22. Then this is 72.69 multiplied by 1.25, 90.86, 90.86. Let me give it green color. Okay. Stop loss zone. So this is 72.69 multiplied by 0.92, which is 66.87. And this is 72.69 multiplied by 0.95, 69.05, 69.05. I'm using decimals here because the stock price itself is very small. It is in double digits. So that's the stop loss zone. Okay. Now have a look at this base. I have taught you a lot in the positional stock trading series. Have a look at this base. The base starts from here. Count the number of red candles inside the base. 1, 2, 3, 4. Out of 4, how many are high volume? 1, 2, 3, 4. All four are low volume, okay? Which means institutions are not selling. Inside that entire base, you see significantly low volume. That's called consolidation. Okay. Let's see how much it has fallen. It has fallen less than 15%. Remember William O'Neill's book, chapter number 2, discussion on flat base. He says that the consolidation inside the flat base is around 10 to 15%, and the number of candles in the flat base are 5 to 6 weeks. So this is 5 weeks. 1, 2, 3, 4, 5. Okay. So 5 weeks of consolidation, 10 to 15% of correction inside the base, tight price action here inside the base, and base coming after base 1, which is base number 2, flat base. And the relative strength at this time was 84 if you check the market Smith chart. And the price here is above price the week before the breakout. The price was above the 10-week simple moving average and below the pivot point. So all the criteria for a flat base, which is written in William O'Neill's book, is satisfied here. So all we have to do now is to wait for a high volume breakout, which comes, by the way. What about risk? Well, this base is risky because the stock, instead of going up 25% before forming a base, it went up 40%, which means there is a good chance that this, instead of becoming base 2, it could become base 2A. After base 2A, it could become base 2B. After base 2B, it could form base 2C. And after base 2C, it could break out. That is our hypothesis. Okay. When you look at the chart like this, see, this is what you see in real time. You don't know what the next bar is going to be. So what are the conclusions you can draw? The conclusions you can draw is, well, this is a proper flat base which meets the textbook definition of flat base. Low volume consolidation. The stock has not corrected too much. There is tight price action, tight closings, tight spreads inside the base. It's a tight base. The price is above the 10-week simple moving average, below the pivot point. So all of our criteria is met. The only thing we know is that there is risk in this base because the price action prior to the formation of this base was very rapid. In 1 month, it shot up 40%, which is very quick price action. So it should take some time to consolidate. This is what we know. This is what we can conclude from what we see. This is how a professional looks at a chart because we don't know what is going to happen next. So we have a hypothesis that base 2A, 2B, and 2C will form. Okay. Now we look at volume on the next week. Okay, because we are looking for a breakout. So what's the volume currently? This is 28 million average volume. So 28 million divided by 5. So we are looking for 5.6 million roughly volume to come on Monday, 5.6 million on Tuesday, 5.6 million on Wednesday, and so on. So that if the next week is likely to be a powerful breakout, then the volume would exceed the blue line. So let's look at Monday. So Monday, the stock actually closed below the 10-week simple moving average, and the volume was also poor, 1.66 million. So Monday is a no event day. Tuesday is a no event day. Wednesday is interesting. See, now Wednesday, the stock again comes up in your filter. Wednesday, the stock is above the 10-week simple moving average. It is below the pivot point. By Wednesday, what's the volume? 13.56. By Wednesday, what was the volume that you were expecting? 5.6 plus 5.6 plus 5.6. Monday plus Tuesday plus Wednesday. So 5.6 multiplied by 3. 16.8 million is what you are expecting to come by Wednesday. But how much are we getting? 13.56. So still not enough. Poor volume. Price is not in the buying range. So you still don't get an opportunity to buy the stock. Stock has come down and has come up. Let's see what happens on Thursday. Thursday, you get a chance to buy. Look at the volume on Thursday. By Thursday, how much volume are you expecting? 5.6 million multiplied by 4. 22.4. What's the total volume? 38.3. In fact, the stock did not even wait for a Friday. On Thursday itself, it crossed the blue zone and closed above the blue zone. So on Thursday, you got an opportunity to buy the stock as it enters the blue zone. So you would buy 50 shares, assuming you plan to buy 100 shares. You buy 50% first, then you buy 30%, then you buy 20%. First, you buy 50 shares, wait for the volume to go up, wait for the price to go up 1 or 2%, buy the remaining 30. Again, wait for volume to go up, again, wait for price to go up 1 or 2%, buy the remaining 20. So you make your purchases in three tranches, but your average execution price must come inside that blue zone. You should not be buying the stock outside the blue zone. Here, the stock has closed powerfully above the pivot point. Not only above the pivot point, it has also closed above the pivot range. Okay. Very, very powerful breakout. The volume has already crossed the average weekly volume. So chances are very low that the stock will come to your stop loss zone. Okay. Assuming you get your 100 shares here. So now the chances of a base 2B and 2C are very low because in a single day, you're getting volume which is surpassing, like, it's beyond more than 50% beyond uh, average weekly volume, right? So when you get that kind of extraordinary volume, now the chance of a base 2B and 2C reduces. It could still form, but the chances are low because when you see such kind of powerful breakout, institutions are buying here. You retail people cannot buy millions of shares. Institutions are at work here. Okay, let's move the price forward. See, the price came down momentarily, but it never closed below the pivot point. It never closed below the 10-week simple moving average. These are good signs. These are signs that allow you to stay in the trade. I'm talking about a weekly close. The weekly close was not below the pivot point. The weekly close was not below the 10-week simple moving average. That allows you to stay in the stock. In this week, you get an opportunity to sell one third of your position size, right? So, as per our trade management plan, which I taught you in the positional stock trading series, which was a 50-part series, you normally buy here, you sell one third here, and you then sell the remaining one third when the stock closes below the 10-week simple moving average on low volume. Then you sell another one third when the stock closes below the 10-week simple moving average on high volume if it continues to go up. Okay. When you sell one third here, you have to move your stop loss to break even because you don't want to lose the remaining two third. Okay. Let's see what happens. Assuming you sell one third here, stock continues to go up. The moving average catches up with the stock. And finally, you have this low volume. So here you would end up selling another one third. And this looks dangerously close to your average execution price. So maybe you will sell here and your stop loss might get hit. No, doesn't happen. It goes again. So here it closes again. So you would sell one third here on in this week. You will sell one third here in this week, and you will sell the remaining one third here in this week because this closes below the 10-week simple moving average. Assuming this week did not hit your stop loss because your stop loss is at break even now. So assuming it is here somewhere in the midpoint of the blue zone, assuming this week does not hit your stop loss, it doesn't kick you out of the trade. Okay. And this is a clear exit sign close below the 10-week simple moving average on high volume. That's a clear sell sign. So you see this movement was not small from here, the pivot point till this, that's another 42%. It's bigger than this movement. Okay. So the stock from base 1 to base 2 went up 40%, and from base 2 went up another 42%. That's too quick of a price movement in too less of a time. That is why the stock is taken time to consolidate now, forming base number 3. By the way, this was February 2021. If I show you the daily chart, this is February 2021, 15 February. Price is above the blue, the green, and the red. So you have to ensure that the stock is in a confirmed stage 2 uptrend by looking at the moving averages on the daily time frame chart before you take a trade on the weekly time frame chart. So just to show you, I have this daily time frame chart for you. But this is how a professional trader would look at a weekly chart. A professional trader would not take the trade here because the relative strength here was 37 or 34, but the relative strength here at the close of this bar, I think was in the 80s, I think 84 or something like that. And that's because the stock moved up very fast in a very short period of time. And now you understand how to analyze the base, how to compare the base with the textbook definition of the base. Where is the risk coming from? The risk is coming from the prior uptrend that came in a very, very short period of time. And the prior uptrend was 40% because the stock took 1 year to consolidate. So we can understand why the uptrend was so powerful, but we don't understand why it did not create 2B and 2C. So these are the things I cannot explain to you. It is just market action. Market action. If you get extraordinarily high volume on base 2 itself, then there is a low chance that the stock will form base 2A, 2B, and 2C. Thank you so much.